Hi, and welcome back to Retirement Planning Basics. In our last segment, I'll discuss with you two real important concepts: expected returns and diversification. We often use the term expected returns when discussing our investment portfolios. As fiduciaries, we're required to make estimates of risk and return for each asset class when we construct an investment plan. As a place to start, we utilize past returns and assume that they'll be reasonable estimates of future returns. For want of a better system, we do this even though we know that past performance is not a guarantee of future performance. There's a very credible argument that returns generated over the last half century or so may not be sustainable. Many economists feel that we should scale back our expectations of future returns by perhaps between 2 and 4%. If true, that means we must all save more and accumulate more to provide for our future retirement income needs. With that in mind, we believe that for planning purposes, it makes sense to err on the side of caution. Worst thing that happens if we're too conservative is you get to retirement and have too much money the day you retire. Frankly, I've never encountered that problem in my 30 years experience in dealing with retirees. Nobody says to me, "Frank, I got too much money." Now let's talk about diversification. Diversification is the primary defense against investment risk. But diversification means more than just holding 1 or 2 or even 100 stocks. Diversification means diversifying your investments globally across national boundaries, across the size, growth, and value spectrums. Properly constructed, diversification reduces risk and increases expected rate of return. One of the corollaries to capital asset pricing model, which won Bill Sharp the Nobel Prize in Economics, is that the ideal portfolio would own all the world's traded stocks in proportion to their size in the world economy. That's the stock portfolio that would produce the highest possible return per unit of risk. Well, look, we all know that we can't get every traded stock, but we can economically and effectively capture the vast majority of them using index funds. That's the lowest cost, lowest risk, lowest tax cost way to get the exposure we need in the world's equity markets. Thanks, and good luck with your investments.